What's going on, everybody? We are back. We are back. We are back. Back at it again for another episode of the Trade for Yourself podcast. As always, I appreciate you all for being here and tapping in. Today was a great day for the market. Very, very great day for the market. Jerome Powell gave the market some good news, gave the market some more clarity. So that was very, very good. I'm telling y'all, a lot of money was made today. Okay, a lot of money was made today. So again, I appreciate everybody for coming back to another episode. Let's go ahead and get this thing started because I really want to take the time to provide some context around what happened today and kind of looking at it from my lens, okay? My lens and kind of looking at it and seeing, okay, where do we kind of go from here? What's kind of going on in the market? Let's just look at some things and just evaluate them. Okay. So again, welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. So make sure that you please like this. Okay. Please like this. Please subscribe. Make sure that you hit the notification bell so you can be there every single time that I drop an episode. If you hit that notification bell, I promise you, as soon as I come on here, it will come directly to your phone, directly to your iPad, directly to whatever device, whatever smart device you have. It will let you know that I am on. So please make sure that you click that button so you can just go ahead and come on over here as soon as I come on. Now, the title of this episode, the S&P 500 is bound for a Santa Claus rally. Yes. We got some pretty good news today. I'm going to talk about why I believe that. But first, let's talk a little bit about what is a Santa Claus rally. To make it simple, a Santa Claus rally is a rally that happens in the market in December. Like towards the end of the year, the market tends to have a Santa Claus rally. Pretty much the market tends to move higher towards the end of the year. And the fact that we have some good information, the fact that Jerome Powell gave us some pretty good information today kind of has me in the camp to say that the S&P 500 is bound for a Santa Claus rally. So without any further ado, let me go ahead and share my screen. Let's talk about what happened today. What did Jerome Powell do for us today? Okay, so Jerome Powell had a press conference today, and he had a press conference. He was interviewed at the Brookings Institute in Washington, D.C. And Fed Chair Powell says that smaller interest rate hikes could start in December. Okay, they could start in December. Now, this is very, very good. And this is why the market appreciated this, because Powell finally gave the market clarity in this speech. Okay, a lot of uncertainty has been taken out of the market in relation to the Fed. Okay, because the market has been raging for a while. It's really been ranging for a while because the market has been trying to decide and say, hey, where is the Federal Reserve going? Are they going to have the smaller interest rate hikes? Are they going to give us the 50? Are they going to give us the 75? Jerome Powell, he didn't really say anything that much different than what he has been saying all year long, but the tone was different. He provided a little bit more context in this meeting, and the market appreciated it. So let's go through this article, because this article is going to give us a lot of clarity around what's going on. Now, Federal Reserve Chairman Jerome Powell confirmed Wednesday that smaller interest rate increases are likely ahead, even as he sees the progress in the fight against inflation as largely inadequate. Echoing recent statements from other central bank officials and comments at the November Fed meeting, Powell said he sees the central bank in position to reduce the size of rate hikes as soon as next month. And like they're saying in this article, other central bank officials have been speaking more dovish, meaning that they want to be more easy on monetary policy. They don't want to continue to raise interest rates by 75 basis points and keep doing that. They want to allow the economy to be able to handle what is going on. But He cautioned that monetary policy is likely to stay restrictive for some time until real signs of progress emerge on inflation. Despite some promising developments, we have a long way to go in restoring price stability, Powell said in remarks delivered at the Brookings Institution. The chairman noted that policy moves such as interest rate increases and the reduction of the Fed's bond holdings generally take time to make their way through the system. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down, he added. The time for moderating the pace of rate increases may come as soon as the December meeting. Wall Street applauded the remarks. The Dow Jones Industrial Average closed up 737 points, or 2.18%, to snap a three-session losing streak. Tech stocks fared even better, with the NASDAQ Composite roaring 4.41% higher. The on-the-day equity market surge, the on-the-day equity market surge is a part of a relief rally, wrote Krishna Gua, head of global policy and central bank strategy at Evercore ISI. Many investors feared the Fed chair would take a max hawkish sledgehammer to the recent easing of financial conditions. That overhang has now gone. Now look at this very closely. Like I told you guys in the last episode, okay, remember that the December meeting, the Fed will be having another meeting in December where they will be raising interest rates again, and they will be providing the summary of economic projections, and they will be telling us where they believe interest rates will be going, okay? This particular speech gave us some certainty, gave us some clarity. You see, Jerome Powell has not been giving us much clarity in terms of where he wants to go and where other members want to go. And to be honest, I understand, because inflation has been very, very rampant. But now the Fed is being more data dependent now. They're not just being hawkish just for the sake of being hawkish. They're taking in the data, looking at what's going on, understanding that, look, we can't just keep raising interest rates into an impending recession, because we could put ourselves into a bad position, right? Really, really, truly could put ourselves into a bad position. So what they're saying now is that now what they're trying to do is now they're trying to be a little bit more nimble, right? They're trying to monitor inflation. They're trying to monitor what is going on in the economy, raise these interest rates, understand what's going on in the labor market. In the beginning of the year, we thought that would be very, very difficult. I still think at the end of the day, it's going to be very, very difficult when it's all said and done. A recession will come, but at the end of the day, it may be more milder. It may not be as aggressive. It may not be as bad as what pundits have been saying, like 2008 dot-com bubble, things of that nature. I don't think that's going to happen. But what I see now is that the Fed is being very data dependent, which is helping the market, okay? Now, markets already have been pricing in about a 65% chance that the Fed would step down its interest rate increases to half of a percentage point in December, following 4 successive 0.75 point moves, according to the CME Group data. That pace of rate hikes is the most aggressive since the early 1980s, which pretty much bodes well with high inflation back during that time. Following Powell's speech, the probability for a half-point move rose to 77%. What remains to be seen is where the Fed goes from there. Markets took a more dovish tone from Powell's speech, with the top rate put at just high of 5% by May 2023, and bets that the Fed will cut half a point by the end of the year. The pricing in the likelihood of rate reductions countered Powell's warning that restrictive policy will stay in place until inflation shows more consistent signs of receding. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation, and the length of time it will be necessary to hold policy at a restrictive level, Powell said. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy, he added. We will stay the course until the job is done. Powell's remarks come with some halting signs that inflation is ebbing and the ultra-tight labor market is loosening. Earlier this month, the consumer price index indicated inflation rising, but by less than what economists had estimated. Separate reports that came out today show private payroll growth far lower than expected in November, while job openings also declined. However, Powell says short-term data can be deceptive and he needs to see more consistent evidence. For instance, he said Fed economists expect that the central bank's preferred core personal consumption expenditures price index in October to be released Thursday will show inflation running at a 5% annual pace. That will be down from 5.1% in September, but still well ahead of the Fed's 2% long-run target. It will take substantially more evidence to give comfort that inflation is actually declining, Powell said. By any standard, inflation remains much too high. I will simply say that we have more ground to cover, he added. Powell also added that he expects the ultimate peak for rates, the terminal rate, will be somewhat higher than thought when the rate-setting Federal Open Market Committee members made their last projections in September. Committee members at the time said they expected the terminal rate to hit 4.6%. Markets now see it in the 5 to 5.25% range, according to CME Group data, which I believe is definitely consistent with how the bond yields reacted today, which we'll talk about that. Supply chain issues at the core of the inflation burst have eased, Powell said, while growth broadly has slowed to below trend, even with a 2.9% annualized gain in third quarter GDP. He expects housing inflation to rise into next year, but then likely fall. However, he said the labor market has shown only tentative signs of rebalancing after job openings had outnumbered available workers by a 2-to-1 margin. That gap closed to 1.7 to 1, but remains well above historical norms. The tight labor market has resulted in a big boost in worker wages that nonetheless have failed to keep up with inflation. To be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation, he said. Powell spoke at length about the factors keeping labor force participation low, a key factor in addressing the imbalance between open jobs and available workers. He said an important issue has been excess retirements during the COVID pandemic. So pretty much, the people that were right there on the cusp of retiring, the fact that we had to work from home and we couldn't go to work and all those types of things, that pretty much accelerated the retirements for a lot of people. And that's kind of how he sees and how the Federal Reserve sees why the labor force participation rate has been so much lower. So at the end of the day, like I said before, Powell gave the market some clarity. Like, the market has been paying so much attention to this particular speech, okay? But he gave us some potential. He didn't give us the exact economic projections, but he gave us some potential economic projections that we can look to, right? He's telling us that slower increases will be ahead. They could be ahead at the next meeting. He's telling us that he sees that inflation is still high, right? Which is pretty much what he's been saying all year long. Like, the tone, like things that he's been saying all year long has not been much different than what he said today. He just gave more clarity about where we are going in terms of where interest rates will be. Now, we will get more clarity in the December meeting because at that time, they have to give the summary of economic projections, right? We will probably officially see the 50 basis point rate hike, right? Because this is the thing. Investors were coming into this meeting and they were expecting Jerome Powell to be very, very hawkish, right? Like, pretty much saying that, hey, we're going to raise interest rates again. We're going to keep interest rates very, very restrictive, all things of that nature, right? Which interest rates are going to be at a restrictive level, and interest rates are going to be higher for longer in order to pretty much help cure the inflation. But at the end of the day, he did pretty much admit that, hey, we've done a lot of tightening. We've done a lot of interest rates. We've done a lot of interest rate increases. We have been selling bonds off of our balance sheet. So pretty much he's been saying, hey, we as the Fed, we put in a lot of work, and we're starting to see some things subside, right? We're starting to see some things subside, but he really just wanted to say, hey, like he's been saying all year long, our number one objective is to make sure that we control inflation and we control price stability. But you know, what's also important is seeing this. How did the market react to this, right? How the market reacted to this is very, very important. Now, let's look at the 10-year Treasury note. Now, this is the 10-year Treasury note, right? And so this is a very, very important bond, okay? A lot of people put a lot of money into this particular bond. And this bond was up as high as around 4.3% back in October. It was around 4.3%. This bond yield came all the way down to 3.618% today. Now, that is a very, very steep decline from where we were at that peak, right? Same thing here, the US 2-year note. The US 2-year, it was up there around 4.7%. We were around 4.7% on the 2-year note, and we're down to about 4.3% on the 2-year note. Now, a lot of investors, a lot of economists look to the 2-year note as pretty much that marker for saying, hey, where will the Fed get for the terminal rate? Like we're talking about on the terminal rate. The 2-year Treasury note will tell us, the 2-year note will pretty much tell us, okay, where is the Fed going in terms of interest rates, right? Seeing that these bond yields came down so substantially and have been coming down so violently, that lets me know that people are willing to put more money to work, right? That they're putting more money to work. They want to put some money away into these 10-year Treasury bonds. Continuing to see these yields move higher continues to see people selling off bonds. That there's no demand for it. When the bond yields come down, that lets you know that there is more demand, right? And that investors want to put more money to work. They don't want to leave money on the side in cash, right? That they don't want to leave more money on the side in cash. They want to put more money to work, and they're feeling more comfortable, right? They're having more faith in the economy. You see what I'm saying? Having more faith in terms of getting more certainty, understanding what the Fed's going to be doing, things of that nature. That's very, very important, right? And so Jerome Powell pretty much helped us out today, because I'm telling you, a lot of money was made today because today was a very, very good trading day, and we had some very, very good technicals. Okay, we had some very, very good technicals. So this is what I want us to do. Let's stop sharing this screen and let's open up Thinkorswim. Okay, let's open up Thinkorswim. Okay, and let's see what is happening. Okay, what's happening in the charts, because I really truly want to evaluate these charts so we can understand what is exactly going on here. What is exactly going on here? So this is a chart of SPY, right? This is a chart of SPY, the ETF that tracks the S&P 500. Now, remember what we talked about last week. We were talking about key levels. We were talking about technicals. We were talking about, okay, where is the S&P 500 going to kind of go, right? And last week we were talking about, okay, the S&P 500 coming down to 3,500, the S&P 500 coming down to 3,500 by the end of this year, which pretty much will be saying, hey, SPY could come down to 350, which I don't see SPY coming down to 350 at this point. It's very, very unlikely for the S&P 500 to come down. That's why now, with investors having so much more clarity and so much uncertainty being put behind us in terms of what the Fed might do, it gives the market the ability to kind of move the way it wants to move. Now, look at this big candle. Okay, let's get first thing I want to look at. Let's get a little bit closer to trading. Okay, more recent trading. Okay, we've got a very, very big candle here. This is a very, very big candle. We were at 393.48 at the low, and we went to 407.68. Okay, we closed at 407.68. We closed at the high. Okay, understand that now. We didn't just hit the high and then come down. We hit the high, we closed at the highs of the day on today, which is very, very important. Let me add in another important layer. Okay, let's add in another important layer because I want to add in the volume, right? Let's add in the volume right here. So last week was Thanksgiving week, right? And last week was Black Friday, right? Volume was very, very low on Black Friday, but we had 2 red days, okay, before we had this big green day. Understand this. I talked about this in the technical analysis episode, okay? Okay, the market going in one direction, okay? Declining stock prices with declining volume gives me no confirmation, okay? If the market is declining, but the volume is very, very low, I don't believe it because there's really nobody there trading. It's pretty much just algorithms just trading, okay? Nobody is trading at that time. I need high volume. I need high volume with declining stock prices to give me confirmation of a downtrend. Same thing on the other side. If we have declining volume to the upside, okay, like if we have declining volume as we're going to the upside, it's no confirmation because nobody is trading there. Understand this. We had a huge day for the S&P 500, and we had 144 million shares traded. I'm gonna say that again. We had 144 million shares traded. Okay, that's the third highest. That's the third highest number of shares that we've had traded in the last 3 months. That is confirmation for a move, right? That's telling you where the market wants to go. The market is showing you where it wants to go. When we're talking about this is the third highest volume that we've seen. Okay, the third highest volume that we've seen in 3 months. That's very, very important for us to put into our back pocket and understand, right? We've got some key volume. On top of this, we broke out of resistance, right? This was a resistance level. This was a resistance level that we could not break above. We could not break above 403. Okay, we have not closed above 403, y'all. We have not closed above 403 in more than 2 months, right? Almost 3 months now. And so now we closed above it, right? We closed above it. We're approaching this 410 level, right? We're approaching 410.97, 411.73. We're approaching key resistance levels here, and we broke above it and we closed above it. That's very, very important. We have a semblance of a double bottom here, and we broke out, right? We broke out. Now, let me add a little bit more context behind that at the same time. This RSI right here is at 63.7. Remember what we said about that RSI, that relative strength indicator, it being too high. Okay, we're getting to the point to where we could be getting overextended. We may need to have a little bit of a pullback, which we probably will have a pullback. But if we had a pullback, came back and retested this 403 level and then kept pushing higher, that's more confirmation for the bullish move. Okay, so we broke out of a major trend. Okay, we were in consolidation for a good period of time, and we broke out of that trend. That's a very, very good sign. Okay, that's pretty much one of the first times that we have been in consolidation this year, and we broke out of that trend to the upside. Right, like we broke out of consolidation, like right here in May, we had a whole lot of consolidation right here. And we broke down, right? We had a lot of consolidation and we broke down. Here we got some consolidation, we broke higher, right? Okay, what else do I want to add? Let's add in some moving averages, shall we? Let's add in the moving averages, okay? Let's add in the 200-day, the 200-day moving average, okay? Okay, the chart just went crazy. Okay, there we go. Okay, all righty, 200-day moving average. The 200-day moving average is 404.14. We broke above it and we closed above the 200-day moving average. Okay, that's the first time that we have gotten above the 200-day moving average since April. Okay, put that into context. That's a long time since we have been above the 200-day moving average. Look, trust me, I understand, like I told y'all before, the 200-day moving average is a lagging indicator. Okay, a moving average is a lagging indicator, but at the same time, a moving average is a psychological indicator. Okay, it's psychological, right? Traders are watching that 200-day moving average. The fact that we were able to get above it and close above that 200-day moving average is a very, very good sign, right? It's a very, very good sign at the end of the day. Now, what I want to do is I want to draw a trend line because at the end of the day, to be completely honest with you, we're still in a bear market at the end of the day. Like they said in the article, we are having a relief rally. We are experiencing a relief rally. But at the same time, I want us to look at this trend line and see, okay, where are we at now? Where are we at in relation to the trend line? Okay, so remember, we are in a defined downtrend, okay? We are in a defined downtrend, but I want you to look at something. Look at something very, very closely. We've already talked about the 200-day moving average, right? We've already talked about that. We've already evaluated why that's important, okay? Let me turn off some volume a little bit here so I can kind of get a little bit more clear on my chart. Now, let's get a little bit closer here, shall we? Look at what's going on. Look at this trend line, right, that we can draw. Look at this trend line that we can draw from the beginning of the year all the way down. Look at where that trend line is. We are kissing that trend line, right? If we can break above that trend line, y'all, okay, break above that trend line. We've got key resistance as well. Let me go ahead and mark this key resistance too. So we've got key resistance here, right? We've got key resistance here around this 410, right? Right around this 410, we've got some key resistance here, even going back to February, right? We're right in that area, y'all. We break above that 410, close above it. You're talking about potential for 420. You're talking about potential for 430 on the high side. Now, I'm not saying that we're just going to go up there. We're going straight to 430. It's not what I'm saying. But 410, it's not going to take us that much more to get the 410, right? If you look over here to the right, SPY is actually trading right now in the aftermarket. We're at 408 in the aftermarket right now. The futures market is actually higher right now. And I anticipate the market to be green tomorrow. It's a pretty good possibility that could happen. We have the PCE numbers coming out tomorrow from October. So we've got to watch that. But at the same time, if those numbers are good, I anticipate the market being higher on tomorrow. So what you want to look at and what you want to examine is like, okay, like I'm like we're on a downtrend. I see that, but we're pretty close to breaking out of this trend, right? We're pretty close to breaking out of this trend. Now, full disclosure, first thing I want to tell you is that even if we break out of this trend, and even if we have the Santa Claus Rally that I'm talking about, and we close at 410 or 420 or 430 on the year, it doesn't mean that we're out of the woods yet. Right? It doesn't mean that we're out of the woods yet, because I want you to keep in mind about the impending recession. I want you to keep in mind and ask yourself, how is this recession, how is this recession going to affect the earnings of the companies in the first quarter? How have these companies actually done in the fourth quarter of this year? We don't know. It remains to be seen. But in January and in February, we're going to find out, right? Also understand this too. February and March are seasonally bad times for the stock market. Okay, so even if we do have some good upward movement, look, I'm not gonna lie to you. Right now, I'm bullish right now, and I've got some more things I want to put into your mind just to tell you, but right now, I'm bullish for the remainder of this year. That's the thing. For the remainder of this year, 2022, that's what I want to tell you. Now, when we start getting when we start talking about January 2023, that's a different story. I would tell you to be a little bit more cautionary. I would tell you to say, hey, let's just see what the companies are doing. right? Let's just see what the economy as a whole is doing. That's what I would tell you. But for the remainder of this year, I feel very, very good. Now, what are some economic indicators that we are still going to have to pay attention to? We still have to pay attention to the jobs numbers, right? Remember what they were talking about, the labor market. We need the labor market to come back in balance. The labor market comes back in balance by job openings going down. The labor market comes back into balance by more people coming back into the labor force, more labor force participation, more people participating in the labor market. The labor force, the labor market comes back in balance when the unemployment rate goes higher, right? We've seen the job numbers come down. I believe they're going to continue to come down, right? PPI and CPI numbers, inflation. Is inflation actually coming down? I believe that we are going to see some good inflation numbers when they come out in December. Why? Because think about it like this, the price of oil. The price of oil, we have seen the lows. We are at 52-week lows in terms of looking at the price of oil, the lowest that we've been all year. We hit those lows in the month of November. So pretty much the decline in oil, that continual precipitous decline in oil that we have had for the entire month of November, that's going to show up at the next CPI reading. You see what I'm saying? That's going to show up. So what is that telling me? That's telling me that I believe that inflation is going to be better than expected again, right? Which may cause the Fed to be a little bit more dovish as it has been being, right? Take all of these things into context. Take all of these things and put these things together, right? Like I said, do not put me on record. We are not out of the woods yet. I'm only telling you how I am feeling from now until the remainder of this year. But we have some good economic indicators that I believe we can hang our hat on that's going to lead us into the Santa Claus rally that I am talking about right now. Let me remove that drawing real quick. This is what I want to kind of show you real quickly here and just add some context to this, right? We're in a bear market, okay? We're in a bear market. The market hasn't been doing so hot this year, right? But right now, the S&P 500 is down around 15% from its high. It's down about 15% from its high. So right now, we're out of bear market territory right now. It doesn't mean we can't come back down and dip back into it, okay, sometime next year, which I believe that's a possibility, right? But right now, we are out of the bear market territory for the S&P 500, okay? So we talked about the S&P 500. Let's go over here and let's look at the Dow Jones Industrial Average, okay? Let's look at the Dow Jones Industrial Average. Now, the Dow Jones Industrial Average is telling you it's telling you a little different story here, right? The Dow Jones Industrial Average is giving you a slightly different story. The first thing I want to do is I want to measure how far down are we in the Dow Jones Industrial Average? How far are we down? Right? How far are we down? The Dow Jones Industrial Average is only down 6% this year. Through everything that we've been through all the ridicule, through all that, this ETF, this index is only down 6%. Okay. Look at this resistance. We've got some resistance right here at around 343.09. We've got some resistance right here at 343.09. And we broke above it. We broke out of this resistance right here at 343.09. So now we can look at 354 as kind of like that next level of resistance, okay? The Dow Jones is moving very, very nicely, right? When you think about the Dow Jones, what do you think about? when you think about the Dow Jones, you think about Nike, you think about Caterpillar, you think about McDonald's, you think about Honeywell, you think about Visa, right? You look at all of those companies, you look at all those charts, they've been looking pretty well, that they've been doing pretty nicely over the last month and a half, right? So I say that to say, keep your eye on the Dow. Keep your eye on the Dow, because the Dow can really give you some opportunities, because the Dow has been doing some outperformance. But like I said, I always have to provide context. Everything is not all rosy. Okay. Here's one thing I want to show you very quickly here. Let me get a little bit closer. Okay. 3-month performance on the Dow. Look at this RSI right here. We are getting we dipped into oversold territory. We dipped into oversold territory last Friday. We're probably gonna, if I was a betting man, we're probably gonna dip back. We're probably gonna get back into oversold territory on tomorrow, possibly Friday. So we're getting very, very overextended on the Dow. So the Dow's probably gonna pull back some. The Dow's probably gonna pull back some. Okay, so keep that in mind right there. Caterpillar's been running crazy. Honeywell, Amgen, United Health, a lot of these companies that we don't think about a lot, they've been running. Okay, but there's one last ETF I want to look at, QQQ. QQQ, right? Let's look at QQQ here. QQQ is telling what is QQQ saying? QQQ is telling us another different story. It's a different story from the Dow, which is a different story from the S&P 500, which is also a different story, right? But look at this right here. What has the performance on QQQ been? Right. Like right now, what is the performance on QQQ? Because I really want to see this, right? So from our highs, these are our all-time highs, down to where we closed today. QQQ is still down 27.7%, right? QQQ is still down substantially, right? But that tells you though that QQQ has some more room to run. With the Dow been performing the way as it has been, and QQQ still in a bear market right now, it's a possibility we could see some rotation into tech going into the end of the year, because the Dow has been running so hot, right? It's been running so hot. So they may say, hey, let me take some profits off of the table. Let me put some money over here into tech, and let's do a little bit of running, right? Let's put some money over here into tech, and let's do a little bit of running so we can establish a little bit of rotation here. Okay, look at this is another big candle, very, 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 very consistent. We've been ranging, we've been holding this 280 level. We never broke below that 280 level. I want you to keep in mind, we never broke below that 280 level. And guess where we closed? We closed above 293. We closed above 293, which is a key level of resistance that we've been looking at. Now we did close right at this resistance back here in September. So we've still got some levels that we've got to break through. I'm going to say this again, okay? By no means am I sitting up here trying to tell you and trying to sell you a dream, saying that we're out of the woods. We've still got a lot of work to do. But the one thing that we can say is that some uncertainty has been taken off of the table. We can pretty much look at and make a projection in terms of saying, what is the Fed going to do in December? Now the Fed is going into a quiet period. They're going into a quiet period where they can't say anything. They're not going to be speaking. They're not going to be moving the market like that. And so now Jerome Powell went ahead and said, hey, y'all, this is what we're doing. Inflation is still hot, but we do understand that we've done a lot of work already. We are looking at what is going on in the economy. We will be giving you more economic projections because that's our job. But at the end of the day, this is what I'm going to tell you. We're going to be having some smaller interest rate hikes. I'm not saying that we're stopping the interest rate hikes, right? We're still going to continue to keep the interest rates higher for longer. And that's the thing. Whenever the Fed says we're going to keep interest rates higher for longer, that is, i.e., restrictive. When you hear them say that they are going to be keeping interest rates higher for longer, that means that policy is restrictive. What does it mean when policy is restrictive? That means that the cost of capital is more expensive, right? When the cost of capital is more expensive, that means it's more expensive for people to borrow. It's more expensive for me and you to borrow. It's more expensive for banks to borrow from each other. It's more expensive for companies to borrow to invest. Investing will still be done. Money will still be made. Deals will still be done. It's just the cost of capital is higher, so the deals will be slower. The deals will be slower. It may take a little bit longer for the deal to get done, but the deal is still going to get done by the people that have the money, right? Keep that in mind, okay? Keep that in mind as we're going through the end of this year. Keep that in mind and understanding what the Fed is going to be telling you, because the Fed is going to be giving you some more information. But now we have some clarity. Now we can sit up straight, right? We can sit up straight and we can say, you know what? Jerome Powell gave us some pretty good information. He gave us some pretty good information. He didn't really change the context around what he's been saying all year. Pretty much saying that, hey, inflation is the target. Inflation is our goal. We're going to continue to be fighting inflation. But at the same time, though, what he did do was he did provide context, and he did let us know that the Fed is still data dependent. The Fed is still watching inflation. The Fed is still making economic projections. The Fed is still going to say, hey, we understand that inflation is still high, but we also understand that we have already done a lot of work. Look, y'all, I believe the S&P 500 is bound for a Santa Claus rally, which means that the S&P 500 can do very well for the month of December. But at the end of the day, we still have to keep our eye on the economic indicators, right, to make sure that they continue to confirm what we are thinking and how we are moving. As always, I appreciate y'all for tapping into another episode of the Trade for Yourself podcast. Please make sure you like this. Please make sure that you subscribe to this, okay? Reach out to me in the comments. Let me know how you feel about the Fed. Let me know what you think about this potential Santa Claus rally, because I think it's a potential one that we can have, and we may be able to put it into our back pocket. This could be an opportunity for us to have some very, very good gains going into the end of the year, and making some projections in terms of what we see ourselves doing and what we see the market performing and business performing for next year. Remember, don't pay for it. Trade for it. I'm going to catch up with y'all next time.